In this episode, we will be talking about income from annuities. So when you invest in an annuity, a portion of that is not taxed, but because an annuity continues for the lifespan of the person who purchased that annuity, there are some tax consequences as to when you incur income upon receipt of those annuity payments. So let's get started about talking about it. So the first thing that I want to do is talk about the general taxation of an annuity. So how does this work? Well, annuity contracts generally require that the purchaser or the annuitant pay a fixed amount for the right to receive a future stream of payments. The insurance company then invests the amounts received from the annuitant, and the income earned serves to increase the cash value of the annuity. No income is recognized by the annuitant or the purchaser at the time the case value of the annuity increases because the taxpayer has not actually received any income. The income is not constructively received because generally the taxpayer must cancel the policy to receive the increase in value or start receiving payments. The tax accounting problem here is that we have to apportion the amount received as a payment either as recovery of capital or as income, because we don't get taxed on something that was already ours to begin with, like a loan. So when we are computing the exclusion amount or that recovery of capital, we've got a couple of options. The first is that we take the investment and we divide it by the expected return, and then we multiply that by the annuity payment, and that creates the exclusion amount. The expected return is the annual amount to be paid to the annuitant multiplied by the number of years the payments will be received. But when the payments are for life, the taxpayer generally must use the annuity table published by the IRS to determine the expected return. So let's go to our example. Tom, age 60, purchases an annuity from an insurance company for $90,000. He is to receive $500 per month for life. His life expectancy is 24.2 years. The 24.2 years is from the annuity starting date. What is his expected return and tax consequences? So the first thing that we have to do is figure out what his expected return is going to be. So we take that $500 that he's going to receive per month and we multiply that by 12 months. And then, since he's going to receive these for 24.2 years, we have to multiply it by that amount. In that regard, he is expected to receive $145,200. Now, to calculate the exclusion amount, we take the $90,000 and we divide that by the expected return, $145,200. Expected return. And we multiply that by the annuity payment. And that gives us an exclusion amount of $3,719. That is the non-taxable return of capital that he is to receive per year. So if we take the $500 that he's to receive per month, multiply that by 12 months, that gives us $6,000 that he's going to receive in annuity payments per year. We subtract the $3,719 of that exclusion amount, and that gives us an amount of $2,281 that is treated as income that he has to include on his tax return. Now let's talk about the exclusion ratio. This is where the investment is divided by the expected return. It applies until the annuitant has recovered his or her investment in the contract. So once the investment is recovered, the entire amount of subsequent payments is taxable. And if the annuitant dies before recovering the investment, the unrecovered cost, or the adjusted basis, is deductible in the year payments cease, usually in the year of death. This comes about when the annuity is for life. So at some point, the recovery of capital is no longer going to be applicable if you live beyond, in Tom's case in the previous example, 24.2 years. At that point, all of the additional annuity payments are going to be income. Now, if he dies before that, if he dies before 24.2 months, then we've got a situation where he's got to be able to recover more of that capital investment in the year of his death. So let's go through another example. So assuming Tom receives annuity payments for 25.2 years, or 302 months, what are his tax consequences? Well, here we take the 302 months that he actually lives, and we subtract out how many actual payments there should have been. So 12 times 24.2 for the number of years that he was going to receive this, and this gives us 12 additional months. Okay, so here what we're saying is that he lived for 25.2 years. How many additional months must we include as income for those $500 payments? Well, the last 12 months that he received any annuity payments, he's going to have to include in income. However, let's assume that Tom dies after 36 months. What are his tax consequences? Well, if this occurs, then we take the cost of the contract, which was $90,000, and we take the cost previously recovered, so previous recovered, and we calculate that by taking the $90,000 and we divide that by the expected return of $145,200, and we multiply that by the 36 months that he received payments, and we multiply those 36 months by the actual amount of the payment, which then equals 11,157. I'm going to quickly erase that so that it all looks really nice. And so his recovery of capital in the year of his death is $78,843. This is treated as a deduction on his final tax return if there is any additional income that he incurs during the year of his death. Well, that seems really complicated, so there is actually a simplified method for annuity distributions from a qualified retirement plan. A simplified method is actually required for allocating basis to the annuity payments received under a qualified retirement plan. The portion of each annuity payment that is excluded as a return of capital is the employee's investment in the contract divided by the number of anticipated monthly payments determined in accordance with those actuarial tables. The rules for annuity payments received after the basis has been recovered by the annuitant and for the annuitant who dies before the basis is recovered are the same as the exclusion ratio method discussed earlier. So let's go through one last example. Susan, age 69, receives an annuity distribution of $500 per month for life from her qualified retirement plan beginning in January 2017. Her investment in the contract is $100,100. How much is excludable and how much must be included as income? Okay, So the excludable amount of each payment is calculated as follows. We take the $100,100 of the investment and we divide that by the number of monthly payments. So here, the simplified method has calculated a number of anticipated monthly payments. The number of payments is 210 monthly payments. So then this number, do this, equals, rounded up, $477 per payment is the excludable amount. Excludable amount. Thus, if she receives an annuity payment of $500, we subtract the $477 of the excludable amount, and that gives us $23 of each annuity payment that must be included in Susan's gross income. So this is treated as gross income. Okay, so thanks for watching this video on annuities and when you include payments in income or how much of that payment is included in income. If you have any more questions, feel free to reach out either by commenting in the comment box below or you can email me at centerfortaxstudies@gmail.com. Thanks so much for watching. Please subscribe, give this a thumbs up if you liked it. Until next time, have a good tax season.